Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. We're recording this interview on Monday, February 16th, 2026. The Dow did hit 50,000 last week. It hit an all-time high on a nominal fiat currency being driven. Gold and silver are in a little bit of a correction. Gold is still around $5,000 an ounce. Trump has installed his Federal Reserve Bank chairman, or at least one of the ones he potentially wanted, and we'll see if he gets his interest rate cuts or not. Today's special guest is a returning guest. He's been writing the MacroVisor macro investment newsletter and the TraderAid trading service for many years now. He also has a tech background, Mayhem of Markets and Mayhem. Thank you for joining me again.
Thanks for having me, Jason. It's a pleasure to be back with you.
So, Mayhem, recently you put out a new article about like the big technology companies, the large caps, the hyperscalers having another DeepSeek 2.0 moment. Could you maybe talk about that? Because DeepSeek, the first DeepSeek moment, it did cause a sizable stock market correction, and then within a couple weeks or a month, the stock market was rallying in. Do you think that this time is different?
I think that it's a similar reconsideration phase, and it comes down to a convergence of different things that are happening at the same time. We know, and we've been talking about this on your show for a little bit, that this was eventually going to become a concern. That the upsized Capex spending and plans of increasing it even more are starting to rattle the nerves of investors a bit. They see the spending, they don't see the return on investment happening commensurate with that spending. That's one issue that I think is starting to concern investors. And we see it during the earnings calls this quarter when Microsoft, Google, and Amazon all talked about this larger capex, both what they had spent during the prior quarter and what they were planning to spend in the quarter and year ahead. Markets were concerned. They sold all of those stocks after they announced those upsized capex spends and plans ahead. I think that's part of it. I think the other part of it is what's happening across the entire AI stack is a continuation of a theme we talked about early last year, just after DeepSeek. And really, I've been talking about it on social and in some of the content that I write. It's the AI efficiency evolution. With the models that dropped last week, that evolution is accelerating. The basics of it are we went from a situation where the idea of how you really take advantage of the AI market was scale, which makes sense because in previous industries, it's been about scale. It's been about economies of scale so that you can bring down your costs, so that you can offer more, do it at volume and accept a relatively low margin, but at a scale that it's okay to have that. Now we're starting to see it change. So instead of having the largest amount of compute or, gigawatts as we're somehow describing this stuff in terms of power rather than compute, it's a lot more about the density of intelligence in models. So going back to last week, some of the startup labs in China released some pretty powerful models. ZAI released GLM-5, which is its biggest model that it's released publicly that I'm aware of. It's about 700 billion parameters or so, and it's very capable. It's not necessarily as good as, say, GPT 5.3 Codex or Opus 4.6, but it's darn close, and it's one of the closest models to come out of the Chinese labs, and it's a fraction of the size of the larger models. I mean, I think it's fair to say something like Claude Opus 4.6 is probably at least 1.4, 1.5 trillion parameters, similar size for GPT 5.3. So here's something coming in at half the size and punching well above its weight. Then Minimax, another lab out in China, and both ZAI and Minimax IPO'd recently, and they've had quite a surge in Hong Kong. They released Minimax M25, which is a 230 billion parameter model. It's not tiny, but it's much smaller than the frontier class models that are generally a trillion parameters or larger. And similar to GLM-5, although albeit a more limited model given its smaller size, but it's still punching way above its weight. And it's able to do things. And I've worked with these models, all of them myself, so I'm able to speak with some degree of authority about their capabilities. It's able to do things that were previously not possible on these smaller models. And then today, Alibaba dropped Quen 3.5, which is, I think, a 394 billion parameter model that similarly is a fraction of the size of these larger frontier models and yet is able to punch way above its weight class. And so all of that put together, and this is just the model layer of the AI inference stack. We'll talk about some of the other layers and efficiencies there a little later on, but all of this shows us that in the model layer, we're able to do more with less. So instead of this being a race for scale, the new most important metric is the density of intelligence. And that changes a lot of the discussions that need to happen about how companies might be able to win this race. Because as this is happening, the price floor is dropping by 90 to 95% for tokens as a service. It's also allowing more and more people to take advantage of local inference, including myself.
And these software programs are constantly improving, like the text to video programs, the stuff with Google VEO3, Nano Banana, Sora, the Chinese ones. It's amazing. Now they can't do, full length movies yet. I don't even know if they can do a 20 or 30-minute anime episode, but they're doing like 8K HD quality video. Like it's unbelievable some of the stuff that they're putting out as demos.
100%. And C Dance 2 came out recently, which is a just absolutely next level video generation. Higgsfield has some great stuff. There's something that the Door brothers said on their Twitter account about 5 hours ago. They're claiming they just made a $200 million AI movie in just one day. So we may actually be starting to cross that threshold of being able to make feature length content. I haven't personally verified this. They don't have a link to the full movie, so it may still be a little bit of just building excitement. But I will say on the other side of it, character consistency, something that was a big challenge in AI video creation for a long time, has become so much more stable now, which means you can have a persona that's totally virtual and have them be consistent in their appearance across different parts of the video and at different angles, something that was previously very challenging.
Now you mentioned gigawatts and compute. So the industry, Meta especially, they announced huge capex increases. They're building out Hyperion, these massive data centers, which are basically a collection of supercomputers or a neural network to build out a supercomputer for massive computing power. There's enormous real world constraints. I don't know if big tech understood what they were getting into, not just with the amount of costs for construction costs, but the power costs, the water costs, the amount of memory chips required. Mayhem, I saw an article. It came out a month ago, but I saw it like last night when I was preparing for this interview from Tom's Hardware. It said that all the data centers that are being planned, they're going to use up 70%, approximately 70% of all the memory chips that are going to be manufactured. That's just mind boggling.
It is incredible, and it sent memory prices up two, three, four, five, six-fold, depending on what kind of memory you're looking at. This is having add-on effects, ripple effects across many different areas. For example, telcos who have to deploy routers, the memory that goes in the router is now 5 times more expensive. If you're buying a mobile phone, you're likely to see less memory on your phone because of how much more expensive it's become. This also goes into personal computers. And of course, this demand is not only from pre-ordering, which I'm told we're pretty much booked through 2028, but the other side is that it's from Sam Altman of OpenAI reserving about 40% of the global raw or unprocessed wafer supply, one of the core components that goes into making these memory chips. And that also takes supply offline that could otherwise be feeding industry, whether it's data center build outs or personal and professional computers and things like that. So there's a number of different things, some of them perhaps a little bit more tangible than others. I think OpenAI is reserving all of that wafer content for what they ostensibly claim will be their future data centers is adding a lot of upward pressure that wouldn't otherwise exist. So that maybe calls into question some of the sustainability of this, especially because I think we're seeing increasing signs that OpenAI is having its own existential crisis, at least at the highest echelons of the company. They really seem to be struggling.
Oh yeah, they've had huge fundraising issues, and Nvidia was supposed to put in $100 billion approximately for investment into OpenAI, and commitment partnership, and they haven't done so. So they've kept. I think they keep stringing them on. They maybe put in a few billion here or there, but not the 100 billion commitment that was supposed to happen already.
Yeah, and there's the rumors that NVIDIA's management, maybe even Jensen Huang himself, had concerns about Sam Altman and the direction and leadership at OpenAI. They tried to walk that story back. It came out as a leak. They publicly said that wasn't a thing. I kind of think it probably still was, because any objective analysis of OpenAI, which, remember, going back, what, 2 years, 2.5 years, Sam Altman confidently promised PhD level AI in the years ahead, near term. What we have instead seen this company pivot to is video slop, promises of text chat erotica for ID verified users, and interstitial ads built into the chat. These are all things that are last resort plays. In fact, Altman himself even said as much about ads, saying that we wouldn't do this unless it was an absolute last resort. This is also a company that's seen an exodus of management, of talent, and the developer ranks and researcher ranks. So I feel like there's a lot that kind of calls into question the viability. And it going to Nvidia, the idea, I think, was Nvidia was going to invest up to 100 billion so that OpenAI would buy more Nvidia stuff, at least in no small part, because a lot of these circular deals are predicated on that kind of, hey, I'll lend you this if you just buy my stuff with it. But it shows on the other side of what's happening with OpenAI. There was something that Sam Altman said. I want to say it was back in October, November, and then it came out in the public again recently, where he wasn't super happy with the inference speed of NVIDIA hardware. And I get that, in the sense that if you're running a company at the scale of OpenAI and you really just need to deliver things at a low latency and just open up those pipelines, that there are times that even powerful GPUs with really fast VRAM may not be able to satisfy demand, especially with the cost involved with building out those clusters. So OpenAI partnered with and invested in Cerebras. They're the company that makes those really, really big AI accelerator chips. They're these giant wafers like the size of a pizza. And they just rolled out their OpenAI GPT Spark model, which basically I think it's able to deliver up to 1,000 tokens a second, which is much faster than their baseline model. It's also a smaller model. It's not as smart. It's probably a sparse mixture of experts model. But at the end of the day, it's at least a prototype that kind of gives us a sense that these Cerebras wafers could help to accelerate inference workloads and provide another option away from just being an NVIDIA-centric world. We've seen Google with their TPUs 70% more efficient, much cheaper to buy and run. We're starting to see more competition come online from other companies. So I think that that's a good thing for the space, but it's not a good thing for some of the pick and shovel sellers. Sorry, you were saying.
Well, especially OpenAI and ChatGPT, because I obviously don't have a tech background like you, but I can look at things like market share. I can look how when ChatGPT releases a new model, paying customers are canceling. So those types of things for normal business operations are not good. It looks like negative scaling, where the more capital expenditure they spend to release a new product, a new piece of software, or scale up with the data centers, the more money they're losing. It's harder and harder for them to raise the capital they need. And on top of this, they're also losing market share to some of these open source models or Google Gemini.
100%. And that's a great point. That's something that I wanted to discuss as well, is that Google, who invented the transformer model, which is what generative AI is built on, it's what we call large language models now. They wrote a paper called Attention is All You Need in 2017. So they are kind of the grandfather of generative AI as we know it now. To think that that company isn't going to be a formidable leader in the space, and we've seen them take shape over the last almost year as exactly that. They started off with some fumbles, some embarrassment, kind of a slow ramp up. But this is often the case for Google. They don't necessarily like to run on the frontier and take a lot of risk. You can see there's a website called Google Product Graveyard, where a lot of the time where they take those risks, they just kill the product because they're scared. They're not sure about burning that kind of cash. So I feel like they've finally come into their own, realizing the inevitable, that AI is in their DNA. And the new Gemini 3 DeepThink model is absolutely next level. So we're seeing more competition from China. We can see it in the metrics of OpenAI ChatGPT versus Gemini, that Gemini is consuming more, OpenAI is plateaued and is rolling off. So it makes your point. There's more competition, and this is at a time where the price floor is dropping. So if you're looking for paid AI, where you need higher quotas and maybe some more sophisticated models or access to a bunch of different types of models, the Chinese labs, and you don't have to use inference companies in China to interact with them. You can run them locally, you can run them on US data centers and things like that. So they're still putting out products and services that are incredibly cost effective for most people to consider interacting with. And we're seeing not just individual users, but developers and corporate users embrace these models. In fact, going back to last year when the DeepSeek moment happened, Microsoft was one of the first US companies to add DeepSeek onto their AI inference product at Azure. Pivoting just a moment back to Meta, you mentioned their Hyperion data center. One of the things that we'd want to hear from management, if we want to believe that they believe in this vision of unlimited compute being needed, would be a big investment in Hyperion. Meta should be really the biggest part of that. But instead, it's being financed through Blue Owl Capital, who will own an 80% interest in the joint venture. Meta is effectively going to be a tenant with the option to leave after, I think, about 5 years. So does that spell high long-term conviction?
Hedging. Yeah, sounds like
yeah,
hedging.
It does.
Well, look at Nvidia too. Nvidia did a hedging move too, didn't they? They went and bought what the founder of the TPU over at Google. He started his own company. There's the other company because there's GROK that Elon Musk has. That's the their AI software in X, the social media. So that's the Grok AI GROK, and then there's GROQ, and apparently there's a lawsuit. But Nvidia just bought the company that's making what TPUs or similar to TPUs, GROQ Grok. That's hedging too, right? So that's admitting that the GPUs that Nvidia is making are not guaranteed to maintain market share, and they want to hedge and they want access to a variation of what the TPUs by buying Grok for $20 billion.
I think that's exactly right. They need to diversify. We've talked about this before, that using GPUs primarily for inference workloads, especially when it becomes things like sparse mixture of expert models, which is what the whole sector is very bullish on. Most of the models coming out are these types of architecture. It tends to be a bit cost ineffective. You've got a lot of compute you're not using. So what's the most important part? The speed of the memory. And so if you can put in another AI accelerator that gives you the same kind of results at a fraction of the price and cheaper power as well, less heat to have to exhaust and cool, all of that adds in and is accretive. And that's kind of what Grok's product and Cerebras and a lot of these others like the Broadcom TPUs that Google has them building, they're all in that space. And this is something that I talked about as early as July of 2024. That the biggest risk that NVIDIA faces as a company is that over time, like everything else in tech, it's going to become both much more efficient, meaning less aggregate demand, and there's going to be more competition on the basis of price, efficiency, et cetera. These are risks that are starting to come on. I don't think it means that NVIDIA isn't going to be the dominant player for the foreseeable future, but I think it does explain exactly why they would hedge buying a company like Grok, and I could see them doing other kinds of M&A in the space just to make sure they have more optionality on AI accelerator chips.
And it looks like there's a chip wars now. So we're seeing these stories out of the last 6 months with Google in-house with the TPUs. Amazon's working on their own ASICs. They have a massive data center. It's in Indiana or Ohio. I can't remember. Maybe they're building in both. Meta is also looking into this. Meta, I think, put in an order with Google for the TPU. So I think Anthropic AI also has an order in for Google with TPU. So would you describe this as a chip war? And that sounds deflationary. And then on top of that, you have the memory shortage. Do you see any specific company like a Broadcom, a Qualcomm, maybe another company our listeners haven't heard of that would take advantage of this opportunity where like NVIDIA's become a victim of their own success with the GPUs, and now the industry is saying it's too expensive, it takes up too much power, too much electricity and energy, and now another company that offers a more efficient solution at a way cheaper price point is going to take market share from NVIDIA?
I think that is inevitable because I know Jeff Bezos liked to say in the early days of Amazon, your margin is my opportunity. Nvidia has juicy 70-75% margins on their data center GPUs. That to me smells like opportunity because those types of margins in the semiconductor space, outside of some very specialized stuff, is pretty rare. And these aren't specialized. These are graphic processing units. They're actually, at this stage of the game, pretty widespread technology, pretty general purpose. And really, at the end of the day, the big outsized advantage that NVIDIA enjoys is CUDA, the software architecture that their inferences run on. That's what makes it so much easier to build, to scale, et cetera, as a developer. But we're seeing competing platforms grow, become more sophisticated and better, like Vulkan, like AMD's ROCm, and some of the others that are starting to become more formidable in the space, which means your switching costs start to come down a little bit. Or if you want to build fresh on a new platform, the learning curve starts to come down a little bit. I think that AMD can be a beneficiary. I think Broadcom, who again makes the Google TPUs, and Google is making incredible strides in efficiency. They're really like unlike anyone else. They are making the most strides in terms of the amount of compute they can get per watt and for the cost of the chip. So I think they're very formidable as competition, and I believe they'll emerge as one of the strongest players in the AI narrative. I also think we need to be aware that this leaves a big gap. And that is to say, for all of this memory demand, there's not enough to fulfill it from US and Korean manufacturers. So it is very likely that Chinese RAM actually becomes much more popular globally. And even here in the US, we can start to see some of the computer integrators starting to buy from companies like CXMT in China. So that's also going to be something that kind of shifts things up. That's going to be a sort of niche that gets filled by a different provider. But at the end of the day, if the RAM is able to work, if it can fulfill the need and it's meaningfully less costly, I think that's going to be helpful to bring prices down. So getting back to your point of, is this deflationary? If you look at technology over any long time horizon, it's almost always been deflationary. And I don't think this time is any different because at the end of the day, you have so many forces pushing and pulling that ultimately help to bring down the aggregate costs for chips, whether it's memory, flash, et cetera, over a longer time span. As Rick Rule likes to say, the cure for high prices is high prices. You get new companies interested, you get new supply coming on. And then also the other side of it is the elasticity that's stretched on the demand side may not be as durable as it seems. Meta's hedging. We see signs that AI Capex spend is starting to rattle investors. On the other side of that increased AI Capex is diminishing buybacks. You actually have buybacks going down last quarter, which was one reason that the Mag 7 was probably starting to underperform and continuing to underperform this year as they shift that Capex into higher gear. And as a result, buybacks consequently have to come down. We also see these same companies looking at less and less free cash flow moving forward, which could start to provoke some challenges if there's any economic uncertainty. But let's go back to that AI stack we talked about. We discussed the model layer. On the chip layer, that's also an important area where innovation is accelerating. This is where we're running the inference workloads. And so going to NVIDIA for a moment, and other companies are following similar trends, but I just wanted to talk about a quantization technique called NVFP4, or NVIDIA Floating Point 4-bit. Quantization is basically compression. It's lossy. What you're doing is you're taking a large AI model, usually they ship 16 bits or 8 bits, and you're shrinking it down to a lower size, 8-bit or less. So let's say, like with Minimax M4, that or Minimax M25, that came out as a 230 billion parameter model. I only have 192 gigs of VRAM. I can't squeeze 230 gigs of weights into that. So I have to use a smaller quant. So I use the Unsloth Dynamic 5-bit quant. It comes in at about 160 gigs, and then I have enough room for my context window to fit on top of that for another like 32 gigs or so, which means I can run that whole model, albeit I'm sacrificing some precision, but with a minimal increase of perplexity or KL variance. And what that means is I'm not seeing a large decrease in quality. So that's with existing tech. NVFP4 takes that to the next level. It takes 4-bit which is half the size of 8-bit precision. And it gives it near the same level of quality and accuracy. And it's able to do inference workloads as a result about 50 times less costly than the Hopper infrastructure when it comes to energy input. So you're already seeing that efficiency evolution through multiple parts of the AI inference stack, from chips with accelerated technology, from the models themselves having a higher intelligence density, and other areas that are increasing efficiency, like less unnecessary reasoning cycles, more efficient agentic harnesses. So I'd say that we're already seeing the early signs of what always happens in technology. It always becomes more efficient over time. And longer time horizons just see that efficiency grow even further. AI is absolutely no exception to that rule. And I would argue that over the last year, that efficiency evolution has accelerated to the point that now the most important metric for large language models is the density of intelligence.
But there's real world constraints, right? So there's this is not related to the shareholders necessarily. This is about local communities with the water constraints and the electricity prices spiking, or how the big tech companies were going after the same power sources as regular communities. So I think now the legislation, there's a huge pushback, and a lot of politicians are running on this, that they're going to make the tech companies secure their own power supply. They're going to have their own power stations, like a natural gas fired power plant. They're going to have to pay to build their own around a data center. Probably that's not that far from a natural gas production area like the Permian Basin or the Haynesville Shale.
I am all for that personally. I think that would make this cycle a lot less problematic for the individuals that could be otherwise significantly impacted by it. We've heard from President Trump. He's creating a framework to negotiate exactly what you've talked about, where companies would have to basically make sure that any costs that are increased as a result of them adding demand to the grid, they have to eat. Anthropic's even come out, and for better or worse, whatever one might think about the company, they've said they'll also cover those increased costs, whatever they may be, to make sure consumers aren't realizing them themselves. Now, we don't know what's all going to come out of this. Right now, it's all talk, but I do believe it's enough of a political issue that it is going to result in some kind of shift as to who carries the burden. Because initially it was, hey, we're going to come out to your region, we're going to build a bunch of data centers, and you're going to see a 20, 30, 50, 100% increase in your power bill. That conversation has completely shifted to the burden now going to AI companies. I think that will be a constant moving forward.
Yeah, it's a trade-off. So you have Meta running TV commercials that they're going to invest $600 billion into the US economy, and it's going to create some jobs. But then the trade-off is that, like, it's bringing a bunch of unwanted uh, negative side effects to the local communities there, with higher electricity prices, maybe traffic or other things there in the water shortages, a lack of clean water, higher water prices, other stuff that the tech companies aren't efficiently addressing. Now, I know Elon Musk at the Colossus XAI data center, he integrated sewage water. So he did an excellent job there with recycling the water systems, but I'm not sure that every big tech hyperscaler that's building out these data centers is focused on, recycling sewage water with the cooling systems and making sure that they don't take from the water supply.
Yeah, the de facto norm is basically take as much as you can until you start getting material pushback. And once you do and it becomes an issue, acquiesce and try to strike a deal. So, kudos if he's able to recycle, dark water like that. That's efficient. And I would love to see more companies take on similar approaches. There's plenty of water that's not fit for human consumption that's just fine for cooling a data center in a closed loop. So I could see that being more of a thing moving forward. I could also see just this whole push for efficiency changing the conversation about the speed of this build out, the scale of this build out, and ultimately how many, quote, gigawatts of data or compute we're building. I mean, again, I take issue with the idea of equivocating watts with computing power, because I have a whole lot of very old computers that take a lot more watts than my current computer that are a lot less powerful.
Well, also the chips, we're in a chip war. I would say for sure we're in a chip war. And it looks like a lot of these tech companies, whether it's Amazon and Google, they're going to be working in-house on faster, cheaper, more efficient chips that use less electricity, less water cooling systems, that are more efficient per chip. Just publishing all this data right now, and they realize that the Nvidia GPUs, they got us maybe to the first or second inning of this, and that now there's huge constraints in the real world, with electricity, and just the cost of scaling this up is astronomically high in many
It
different ways.
is. Oh no, 100% it is. And you're right that anytime you start to see constraints or just companies that are enjoying outrageous margins, I mean, again, 70, 75% margins on their data center GPUs, that's opportunity for competition, 100%. And they are seizing that opportunity. And also, GPUs are really, again, this sledgehammer driving attack in terms of the amount of technology, the power, the thermal output. We don't necessarily need that for every workload. It'll be more important for training. It'll be more important for complex media creation like video and songs and even some of the bigger, more complex imagery. But for mixture of expert models that are largely text driven interactions, we don't need the same level of compute. And so efficiency can become a much bigger part of the build out architecture process. And I think it is. I think Google has demonstrated successfully to the entire world over the last several years you don't need to use a certain company's chips to get the result that you want. In fact, you can build your own in house technology, much like you've talked about. Amazon is doing, Microsoft is doing, AMD is improving theirs, Broadcom, Qualcomm. I mean, we see a lot of different companies in this space, but Google has proven, in fact, you can build your entire stack because they've built their hardware, they've customized a version of Linux for the software, they've built the inference engine that the model runs on, and they've built the model and even some of the agents that run on top of it. Google might be really the only pure full stack AI company out there. And in a way, that's doing it right. You've got full engineering control. You can extract even more efficiencies. On their last earnings call, one of the things that they discussed regarding their recent Capex was even though we've spent a lot, it's driven the cost of compute down by double digits, and we're going to continue with that process.
Well, they also have more data and research than anyone because they own YouTube and they have search and they have the browser, so they can collect data. They've been collecting data, whether for better or for worse. As a libertarian, someone who doesn't like these big tech companies, taking my data without permission. I mean, they've been taking it for so many years. They have access. They have all this great research that people put out basically for free on YouTube, and that's training their models. So,
yeah.
So they have a huge advantage. That's a huge advantage.
It is. It is the largest amount of training data on Earth, and it's theirs. And I agree with you in terms of I'm not a huge fan of all the sort of surveillance capitalism that's built into modern technology. I do think it's very disconcerting, but I will give Google credit where it's due. Even though we probably didn't read the agreements that were involved with signing up for various Google services, they do have the rights to that data. And I only say it with this in mind. Companies like Meta and OpenAI and so many others, and Google to some extent too, but Google has a larger amount of data they've collected legitimately. A lot of these other companies, including Anthropic, they've just taken data that was objectively not theirs. They've pirated the intellectual property of humanity and built a business model on it without being liable for that. And to me, I find that remarkable because, when years and years ago, when the Digital Millennium Copyright Act came out, we were reading stories about Napsters suing 70-year-old women because their grandson downloaded a CD. And now we have companies at a corporate scale pirating all of humanity's information and getting a slap on the wrist.
Yeah, it's called scraping, right? So that's the technical term, is what scraping the internet for all the data. They're not getting permission. They're not paying royalty fees to the business or company that has the intellectual property or did all the research. So YouTube, like if you upload a video, you spend a lot of time making a YouTube video on something technology or finance, and you upload it to YouTube. They basically have access to all that data and research, and they're probably using it to train their Gemini 3 or Gemini 4 or whatever comes next.
And their video creation models. Google has definitely used YouTube as the training database for their video creation models, which are also some of the best out there. And it's no wonder because they have all of that data to draw from. Also, Cdance 2, that's from ByteDance. The guy, that's the
TikTok,
company
that's
behind TikTok.
TikTok, right? Yeah.
Exactly. So they also, in like Google, have an enormous amount of video, and so they've created some of the best video models out there. So even though they've ceded control of U.S. TikTok, now they're making a push in a whole different direction as a company, really focused on growing in AI and becoming more formidable.
Oh, so it's like text to video then, some of the other text to video programs.
Yes,
So,
text to video and image to video.
I heard you mention all these chip companies, and it sounds like there's opportunity there for a lot of them to take market share. I know Qualcomm's working on putting AI chips into a lot of hardware. So whether that's robots or wearables, so the new glasses are going to have more integration, like augmented reality or virtual reality glasses. But the one company I didn't hear you mention is Intel. So Intel, what they had a huge amount of exposure with the Chips Act. The Chips Act, in hindsight, what over $80 billion spent. That seems like a government boondoggle of waste, fraud, and abuse. Taiwan Semiconductor is making progress finally. I think after like 2 years with their Arizona fab facilities. Intel did have a brief pop what with the government the announcement of the government investment in the Nvidia deal. Now some of the data, the information that's coming out from quarterly reports from Intel, it seems to be struggling again. Do you think that Intel is going to get their act together, or do you think that the government's going to continue to subsidize this and this is just going to be one huge mess?
I mean, it's a great question because Intel has been a multi-decade mismanaged company. I mean, this has just been it's been a really big fall from grace for so long, with AMD progressively eating more of their lunch in the personal computer space, in the mobile space, in the data center space. And AMD is an incredibly formidable competitor now. So for Intel to come back and win back contracts with PC integrators and with server builders and otherwise, they're really going to have to demonstrate that they have some incredibly powerful tech. I have heard signs from articles I've been reading about their chips that they've got some really impressive mobile tech for handhelds, that they're starting to build out some next generation PC chips that should be pretty formidable. But I need to see these things in action because I've heard this before. And then when you actually get a hands on demo, the story is a lot different. The other issue that I have with Intel is just when they did those mass firings, they laid off so much R&D talent, and it's hard to get that brain share back and rebuild any kind of momentum. And I don't think that everyone fired was maybe someone who shouldn't have been fired, but I do think there was a fair amount of talent they got rid of that they probably should have retained if their hope was to scale. We've also heard this idea is probably more of a rumor than an actual solid deal, but this idea that in the future, maybe Intel will be producing some of NVIDIA's chips in the future, like 2030 and on. I've heard that floated. I don't know if it's been 100% cited by credible sources, but that would be a major upside catalyst for Intel if they're able to get their fab together and actually start to, build out for other companies. But for me, I just kind of remain skeptical, especially after this big re-rating. It's trading at a forward PE of 49%, and sales are flat. And earnings, I mean, they're not even making a profit anymore. Granted, I know they have things they have to write off and they've struggled with all this kind of reshaping of the company. But everything to me tells me there's this big pocket of air down to about $25. And I don't know I necessarily would want to be getting long after the run it's already had. And quite frankly, that's true for a lot of the chip companies here. I'm not so sure that right now is the time where I'd want to get involved with this space with conviction. I think there's still some froth that needs to settle out. I'm actually more bullish on some of the beaten down software companies. I wouldn't mind buying an Intuit as a buy and hold play. I don't like the company. Okay, I'll put that out there right now. I think they're a bit parasitic in the way that they kind of treat their small business customers. But on the other side of it, the switching costs for something like QuickBooks is extremely high, because you have the platform, you have the merchant processing, you have the bookkeeping, you have the payroll software. And to be able to get away from all that is more than most businesses that are small to medium sized are able to do on their own. Even in this era of AI and Claude and writing your own apps, no one's going to be able to quickly replace that. So I think the re-rating on some of the SaaS stocks that have had this sticky ecology for years and years and years, where customer switching costs are so high, they're not likely to move anytime too soon. And where they continue to raise prices, that's starting to look a little better after the big discount we've had, where software has had the worst 6-month rolling returns ever, worse than the dot-com bust, where short interest in the space is at an all-time high. and where everyone hates it and is just panicking about how AI is going to eat everything overnight. And the reality is that yes, there is more competition. There is a lower barrier to entry in the space, but it's also an incredibly competitive space. And there's some companies that have formed ecosystems that have staying power. So that's where I'd be a little more interested near term in looking for some of the out of favor, beaten down opportunities that could either end up being swing trades or long term investments, depending on one's time horizon.
Yeah, Intel seems to be a mess. There's also rumors that Apple was negotiating with them, but I think most of the tech companies are just waiting to see about their yields at the fab. Intel's been behind for over a decade. What they totally missed the chips for mobile phones with the smartphones. They totally missed that trend. They were really far behind on the AI trend. So they've just been mismanaged for so many years now. I think they fired a lot of their really competent technical people from what I was reading up on them. They kept a lot of marketing people and a lot of lawyers, and they focused for many years one on share buybacks and kind of social financial engineering over actually running the company competently with software engineers and competent engineers, because Intel what has Moore's law, right, for computing power. So they did at one point, they were the king of making semiconductors. Now, that was initially for many, many decades, but the last 15 or 20 years, all that research and development, innovation, the people that were running it that were competent engineers, software engineers for hardware and software, they basically sounds like they were gutted. They were kicked out of the company.
Yeah, I mean, it was a real, I think it was a real disastrous exodus that was caused by all those layoffs because, there's no way you can constructively lay off that many people, many of whom were R&D, and not see a big brain drain. So, I on the other side of it, I get it. They've struggled for so long and not really done much that, maybe on their minds they're like, well, this wasn't the talent we needed. But I don't know. I struggle personally with the idea that it wasn't the management that really led this company into the crisis that they're experiencing. And the new CEO seems to have at least some idea as to what he wants to do, but it's a massive ship to turn around. And with I think about 2 decades of mismanagement, it's probably going to take at least 5 to 10 years to try to turn this into a heavy duty powerhouse like it once was, if there is even a path there. On the other side of it, in the semiconductor space, companies like AMD, Broadcom, Qualcomm, Micron, SanDisk, if they ever settle back to more realistic valuations, they would be things I'd want to buy and hold over longer time horizons because I think they're executing far better. There's a lot less of that mismanagement baggage risk that could suppress future returns and growth.
Now, before we move away from tech to macro and gold and commodities and bond yields with the U.S. Treasuries and all the other shenanigans these central banks are playing with their government bonds, I want to ask you one question about Palantir, because there's a huge argument about that. You have a traditional value investor, Dr. Michael Burry. He was initially just a value investor, and then he got famous, with The Big Short and shorting subprime mortgages. He's talking about how basically Palantir doesn't have any type of technology advantage or software advantage, that basically it's all marketing, that there's a lot of financial engineering going on at the company, that a half a dozen people are billionaires now and the rest of the company is all marketing with government contracts. Do you hold this view, or do you think that Palantir actually has some type of software advantage in the AI space?
So first, I will say that I have a great deal of respect for Michael Burry's work, a lot of it, not this particular one, and maybe not his GameStop long thesis, but what he was able to reveal with regards to the financial plumbing during the great financial crisis and thereafter was actually really, really eye-opening. So I have a great deal of respect from that. That being said, I don't think he has Palantir or GameStop right. We'll focus on Palantir as a short. He's still calling it a consulting company. It hasn't really had that narrative behind it for, I don't know, about 3 years, because most people look at the numbers and they realize that the kind of growth that this company is experiencing without hiring growth. So earnings are growing. They're profit positive over the last several years, but sales are growing as well, but their headcount isn't growing commensurate. So if this was, as he claims, just sort of an FTE, or forward deployed engineer and marketing centric firm, then headcount would rise similar to the growth rate of revenue and earnings, but it's not. It's growing, but not nearly that much. There is real AI at this company. They have a different type of AI. One of Burry's criticisms was him saying they never built a large language model, so that means they're not an AI company. This, to me, sort of illustrates that Dr. Burry does not necessarily appreciate the nuance. All AI is not generative AI. Generative AI is a form of machine learning, but there's a lot of different kinds of AI. What Palantir does is ontology. It's much more data driven, and it doesn't actually suffer from the same sorts of hallucinations and follies that you see in generative AI. It also doesn't require GPU compute of a scale that maybe will run out of power here on Earth. I'm obviously saying that tongue in cheek, but those are the kinds of conversations we were having late last year when people were sort of panicking about energy usage. So I think Burry doesn't really get the business right. I think he's missing it on a number of different fronts in terms of, why this is not just a bubble stock. I do think that Palantir, even after the discount it's experienced, is expensive. It's hard to say it's not too. I mean, when I look at the company's fundamentals, I can see it's trading at about 70 times sales. So it's hard to say that a company trading at 70 times sales or forward PE of 70 is cheap. It's not. It's objectively still expensive. It's also hard to say with any degree of credibility that it's Michael Burry's short thesis that is the reason that Palantir has rolled over when, as we were just discussing, the entire software as a service space has had its worst 6-month rolling returns ever. So it seems like every software company is being sold. A lot of these things are in baskets, and when you're rotating out of them, you're pretty much selling everything in that basket. So again, respect for Burry's overall work and the composite of research that he's built over the years. But this particular short thesis, in my opinion, is off the mark. I think Palantir is a real AI company. They might have a reputation that at times is bristling and uncomfortable. But for folks that have that as their main criticism, ethics or the lack thereof in their mind, I would like to point them to big tech, because everything that people criticize Palantir for and more, big tech does and does a lot more of, whether it's spying, working with governments, doing things that are incredibly ethically questionable or anti-competitive or otherwise, or, just the actual harvesting of the data that people accuse Palantir of when it's really Microsoft and Apple and Google and these other large tech companies. There's a lot of confusion. I get it. It's a complicated space. But I think that as we look more and more, there's credibility to the idea that it's an expensive company and that growth stocks are out of favor, and you could still see some more re-rating lower. But there's not credibility in the idea that it's a consulting firm or that there's financial engineering afoot or that, this is just sort of a bubble company full of marketing.
Well, he's also said that government contracts aren't lucrative at all. And I've lived here in the Washington, D.C. metro area for 25 years now. And I could tell you they're extremely lucrative, especially if you have the right lobbyists and, the right person in Congress or a head of a government agency, a higher up there. They're extremely lucrative. I mean, there was people that were reselling Microsoft software for tens of millions of dollars extra. They were marking it up. So there's tons of scams here. So I guess he's just not familiar with how the federal government works in the DC metro area, because he was saying that government contracts like that for software or for the Pentagon are not that lucrative.
Yeah, and I can tell you when the Pentagon can't account for a third of the money that they get in their budget, or every year they would fail audits, there's so much graft and waste and fraud in that space. It's incredible. And so
they laugh about the failed audits, man. They think it's funny. I've had some often.
There's no accountability. The defense budget almost always grows. There's very few years where it's not growing. And so there's a bigger and bigger slice of pie for companies to take home. But the other thing that people seem to misunderstand is that Palantir is primarily a government contractor. They have triple digit growth in commercial revenue year over year, quarter over quarter. Their growth is still very strong in that segment. It's really one of those companies where even though, again, the valuation is very extended, the growth is remarkable. And that's, I think, one of the reasons they've been given such a premium for so long is that you don't see a lot of companies with triple digit sales growth in the commercial space.
Now, you talked about the software companies being in a bear market. So let's talk about the AI software. So as the AI software improves and gets better, it should make software engineers, computer programmers, small business owners more productive, more efficient. They can do more with less. That would be deflationary. So if you're a software company, you eventually you don't need as many software programmers. You can have software programmers that you have on staff be more efficient with AI enhancing them. You can maybe have higher quality software. You can maybe upsell with some other type of package then to small business. Is this how you see things playing out, that right now the market has overreacted, that AI is going to wipe out the profit margins and sales for these software companies, but over the next 6, 12, 18 months, that the software companies are going to adapt and then they're going to end up having more efficient businesses?
I mean, I think over time in this space, that's one thing that you have to do to survive. Technology has one of the fastest innovation cycles of any industry. So, in order to survive, you have to adapt, constantly evolve, and meet and face challenges and overcome them, or you're going to die as a company. The companies in this space where they're more easily disrupted, where switching costs are lower, where they don't build, inadvertent customer loyalty by having those really high switching costs, or actual customer loyalty by having powerful, good quality customer experiences that build that intangible value. Those are going to be harder companies to disrupt, and I think that they're already. Just about every software company has at least experimented with using AI as a part of their development workflow. And it could be for troubleshooting, it could be for building out scaffolding, it could be for planning, it could be for automated analysis of code for security vulnerabilities. But I'd be very surprised if there's any publicly listed companies in software that haven't been using AI for, at least experimental, if not development and production purposes for years now. And we used to hear it on the earnings calls all the time from just about every company, including companies that weren't even technology related. So for me, I find it very hard to believe that all of a sudden we're going to have AI just sort of disrupt an entire every part, because it's very few companies are escaping this malaise, that we're going to have AI just completely disrupt this industry in an ever accelerating timescale such that no one's going to use traditional software anymore. I think it's a gross misunderstanding of how complex and sticky a lot of these programs and applications and services really are. On the other side of it, the discounting does make these things more attractive to a contrarian investor. Hedge fund allocations to software, multi-year lows. Hedge fund allocations to semiconductors, multi-year highs. I kind of want to be on the other side of that trade. I kind of want to buy what everyone else hates but seems to misunderstand. One of my mentors way back when was a value investor, and his methodology was finding beaten down, out of favor companies that were misunderstood with turnaround catalysts. And so I think that there's a lot of that going on in software right now. I wouldn't call it traditional value, but maybe you could call it GARP, or growth at a reasonable price, with some of these valuations.
Yeah, it would be like Philip Fisher or Sir John Templeton. You're looking for quality, undervalued growth stocks where the market has things wrong. I remember 2, 3 years ago, and I was laying out the thesis for gold stocks that if the gold price went to 2,500, 3,000, a lot of these companies were going to mint money. And I was just getting laughed at. I even sent out emails to the granddaughter of Sir John Templeton. She considers herself like one of the top contrarian value investors. She has books out on this. I mentioned gold stocks and she stopped responding to emails. so they just did, this was like 2 or 3 years ago. They just didn't want to hear that
Yeah.
the gold price could go up and the gold stocks were going to mint money with free cash flow and high profit margins.
And that was a great call, because it was the ultimate contrarian call. There was not only plenty of upside catalysts with accelerating de-dollarization as the US weaponized the dollar against Russia and Iran, but also on the other side of it, you have, I think, a pretty powerful set of contrarian kind of, everyone hates gold and silver back then. Like, no one wanted to talk about adding gold to their portfolio,
They
or
still
adding
do.
gold stocks. And there's still very low allocations in institutions. It's piqued their interest now that it's gone up to 5,000. They're looking at it more like, whoa, what's that? But yeah, it's like what, 1 or 2% at most in most of these institutional portfolios.
All the stuff on social media is the people that miss the run up in gold and silver. And now they're like, okay, it went up enough. It's a bubble, blow off top, time to short it. I see that everywhere on social media.
Yeah, me too. I see a lot of, I missed it, I hate it, I want to fade it type of posts. And I'm like, I get it. These are types of moves that can build significant generational wealth, if you're on the right side of them, missing that hurts. You get a lot of FOMO, and then when you see that, there's this potential that it could roll over a bit, you start leaning into, oh, it's all over, it's all done. Everyone's missed a trade and had that opportunity to feel a little bit of envy for the people that were a part of it. I get it. I get where they're coming from. I just think they're wrong. I personally feel like gold and silver were overdue for this correction. I was actually very vocal warning about this in late January, especially with silver, saying retail flows were at extremes we've never seen. Like the SLV ETF traded 32 billion in a day. SPY trades 24 billion. Nvidia trades 16 billion. Tesla trades 16 billion. So the amount of activity there was like nothing else we've ever seen. And it's in what was once a kind of sleepy ETF for many, many years. We saw the same with the option skew blowout. Call skew on SLV got to extremes I'd never seen before. So when you start to see everyone's piled into one side of the boat, it's liable to topple over. And that's what I started kind of trying to get out there and say, look, I'm not bearish long term, but this is really lopsided. You've got to be careful here. And I got a lot of flack for that. And I get it. That's fine.
Well, that's because gold stocks did nothing for 17 years. I think that's why that people had underperformed that were long gold stocks, silver companies for so many years that they're like, finally. And then you're like, oh, there's going to be a correction. Okay, well, of course there's going to be a correction. I mean, this is you can have a short-term correction of 20, 30% or more sometimes within a long-term cyclical bull market.
And you should.
Secular, not secular.
You want a correction. Yeah, you're 100% right. I also feel this is secular. It's not cyclical. I think this is a longer term, more constructive trend because all the biggest drivers that gold and silver love are online.
Exactly.
Go ahead.
Well, let's just name some of them. What interest rates for all these governments, not just the US. Trump wants the front end of the interest rates cut. You have global M2 that most people aren't talking about. It's almost at $100 trillion. And the majority of the currency creation is not even from the US, it's from China. So that's a huge driver there of commodities prices, especially precious metals. They're going to react to money supply growth growing enormously the last 10 years. And then the other one, I think this is the major macro theme, Mayhem, it's the government bonds. So all these G7, Japan, European Union, China, the US, all these developed countries, their government bond markets, they all look like Banana Republic emerging market type government bonds now with their finances.
Yeah, you have major bear steepeners happening on the long end because it's increasingly questioned, what is this currency going to be worth in 10, 20, 30 years? And, how am I going to reprice the risk that I have to take on from a government that seems less and less likely to be able to repay any of this debt without aggressive deficit spending? The U.S. deficit spend is set to rise to over $2 trillion a year to get us to a national debt of something like $64 trillion within the decade. There's nothing that really is able to stop this cycle either, because if we have an actual reset, it's going to be a very deep recession or worse. And so the impulse for kick the can down the road policymakers is very simple. It's let's extend and pretend within the political cycle. We can't afford an actual recession or a real mess. So let's instead just try to increase spending. And then so on the fiscal side, you've got record deficits. You've got some of the most aggressive deficit spending as a percentage of GDP with unemployment this low ever. So we're already in government emergency support mode, even though ostensibly we're told the economy is just fine. And then you've got the Fed. And even though Warsh is coming in and being described as being more hawkish around the edges, I don't really buy it. I think that the Fed is still going to be in a holding to cutting cycle. And I think they're going to still have to support near-term liquidity in the markets because you see bank reserves and reverse repos dropping. So there's a need for them to kind of come in and make sure we don't have any sort of near-term funding crisis. So I think they'll still lean more towards neutral to accommodating. And if there is any tension in the economy, I think they'll come in and ease again. Then you have global uncertainty economically and geopolitically, and you have accelerating de-dollarization because you've got the prior administration under Biden using the dollar as a weapon, and now you've got Trump kind of roiling the world order. All of this gets people wanting to be less and less in dollars. It does. I know there's
Well,
folks out there
he's
say, "Oh,
threatening, right? So he threatens. It's part of the art of the deal, right? He threatens a country to bring him to the negotiating table with these high tariffs, and the other country is deciding, why do we need to buy more treasuries then? So
right."
yeah, it might get a trade deal done, but then the other country, as part of the trade deal, isn't going to be buying a lot more treasuries. They're probably net sellers.
Yeah, and the other thing is the trade deals don't even have staying power. He's talking about canceling USMCA. That was his deal. And he's describing his own former trade deals as being suboptimal, wanting to renegotiate everything. And I find it all to be very counterproductive. I get that not everything as it was situated was ideal, but I do believe there are more constructive ways to bring up these issues and try to negotiate outcomes than just using, executive order driven tariffs that have no staying power. Any country that can wait you out or influence the political machine doesn't really need to concern itself with those tariffs too significantly because A, they can reroute the shipments so they're not coming from the country of origin with the super high punitive tariffs, and B, they can try to make sure that you don't stay in power, and the moment that you lose power, the next president's going to come in and undo all your EOs because they have no staying power. So I don't feel like that was the best approach, and I think it's accelerated de-dollarization. But I do want to put out this cautious note. I'm bullish on precious metals very much over the long term. I think we're going to have a corrective phase. I think that it's not over yet. Uh, February tends to be a pretty difficult month for silver. I think it only has positive returns about 20% of the time, and we're certainly seeing this be no exception. I think that we're going to see some more of that for one very big reason. Everyone hates the dollar right now so much that it's become an incredibly crowded trade at the same time that we're touching down on a multi-decade trend line. And so these big currency trend lines, they tend to be defended multiple times before they break. I think ultimately it probably will. But as we're seeing some defense here, and as the long end is shooting higher with the 10-year moving above 4.5% and kind of rattling people as the risk-free rate goes up, you tend to see some people pull out from non-yielding metals. I think you do have some headwinds that we have to navigate through. So I wouldn't be terribly surprised if gold's trading 6,000 an ounce towards the end of the year and silver's trading, say, 150. But I think in the near term, we have some headwinds we have to navigate through. We have to also deal with the hangover from all that excess speculation. And there's still a lot of folks out there that are kind of, you know, crying from the mountaintops that all of this is just manipulation. And I get that there is bad acting that happens in this space. We've seen the stories about commodity traders manipulating prices, and all of that. But at the same time, we also have to acknowledge that markets just don't go straight up. And when they do, you need to be cautious. Whatever your discipline or risk management is, anything that goes straight up can go straight down faster than it went up, which is exactly what happened with silver. And I think that you've got to look at trends like that when those types of events are happening, as good as they might feel when you're long, and start de-risking into them and looking for signs in the sentiment, in the flow and positioning that can confirm it's an extreme. Because when you see those extremes, you can get out of the way. It doesn't mean you have to sell your entire position. It doesn't mean you have to hate it and move on. It just means you have to kind of get out of the way from the wobbly activity that'll happen in price, some downward drift, and then regroup when things settle out. And you can look at that as an opportunity to maybe take on some other some other trades, some other spaces, or just to be able to circle back, have some dry powder, and wait for it to come back down to earth. And I think with silver, that's what's happening here. It doesn't mean that it can't go back to the triple digits. I think we just need to shake out the rest of the loose hands first.
Well, actually, it is triple digits in China, in Shanghai, and India. So it's like 90 or 100. There's like over a $20 an ounce spread between the New York spot price on COMEX and the actual price to get ounces. So if you're an industrial end user in China or India, it's substantially higher there still. But now, from the bottom up there, you mentioned the macro forces here and the overbought conditions for silver. Let's just talk about if the silver price stays at $90 in China, other parts of Asia, $90 or higher, or India. If you're an industrial end user, if you're a solar panel manufacturer, or you're making semiconductors and you're using or electric vehicles, a certain amount of silver, you're going to start to look at some point, if your costs are rising that much, you're going to look to start to substitute it. So I don't know how quickly that's going to take. There's articles coming out that they're going to start substituting quickly. I don't think the industrial process is that quick, but if the price keeps going up or stays hot, relatively high, they will look for new ways to start to substitute it. But the silver market for supply and demand, just silver, not the macro forces, 6 years now. The Silver Institute's about to, here in DC, is about to release another annual report for silver. 6 consecutive years now of large supply deficits. So that market, silver was the only commodity, Mayhem, that was not at or near its all-time 1980 inflation adjusted high. It was in the low 20s
Right.
12 months ago. It was a joke. It was way below the production cost. It was not even near its 1980 inflation adjusted high. It was not even near its 1980 high. So that's how much of a mispriced silver was. The market, I think, figured that out. It corrected, it adjusted, it re-rated, and now there's a correction. I think we're looking at higher price floors, though, going forward, because if the silver price does have a violent correction, there's no incentive to bring on a lot of new supply. We're going to need to see 60, 70, 80, probably even higher than that silver for a mining company to want to build a new silver mine for hundreds of millions or $1 billion.
Right. And it's often a metal that's a byproduct of other mining as well, which means there needs to be a focus on it. I think that the overbought conditions have been more than worked off. I mean, we've seen the positioning in SLV ETF come off. We've seen commitment of traders, the active speculators in silver, that's come down too. It was never very high on COT. It was mostly retail. And then we've seen the option skew really come to more bearish levels on SLV. So like we're now on the other side where it's getting a little bit more closer to where I think we might be able to consolidate and form a bottom maybe between $60, $70 an ounce before we start to rally and move higher again. But I do want to see that consolidation and correction because we've got to basically build that healthy price structure, shake out any remaining weak hands so that they're tempted to buy at higher prices when they get FOMO again. I mean, that's what these bull markets really run on. You have periods of intense, upside speculation and then periods of intense anguish that flush out those folks and make them have to come back in at a higher price later on. I think we're setting up for more of that, especially in silver. Gold's been so much more resilient. And from a seasonality perspective, gold actually tends to do reasonably well in February, whereas silver tends not to do quite as well. One of the pair trade ideas that I had put out on Trader Aid is just sort of a tongue-in-cheek, but actually actionable idea was fading silver and going long gold just for the month of February as a way of extracting some value from this sort of rebalancing from extremes. And so far, that's worked out pretty well.
And I think the dip buyers this time will actually be the mining companies. So the gold miners that have really high profit margins, free cash flow, they don't have a lot of debt. If there is a dip, there is that correction. I think the gold miners and maybe some of the silver miners will be aggressive and they will look to do deals. There will be mergers and acquisitions. There will be buyouts. So I think they were waiting. We haven't seen quite as many deals as I was expecting. There's been a few. I think Hecla sold their gold mines recently. I don't really like that deal. They were a silver miner and they had some producing gold mines in Quebec. They had some nice diversification. The gold mines have better profit margins. I didn't like them selling their gold mines and going all in on silver. I would have rather them keep some gold mining revenues, a large chunk mixed in there. But I think we're going to see some aggressive mergers and acquisitions because the mining companies actually have cash. And if you're a mining company, you don't get a higher valuation for holding cash. So I think they will look to go buy good assets if there is that dip that you've been predicting.
Oh, and also, speaking of silver and switching away, something you were mentioning a little earlier, Pandora, which I believe is one of, if not the biggest jewelry company, completely switched away from silver and will now be making platinum plated jewelry,
Huh.
which I
Wait,
find to be
if it's platinum
revolting.
plated, what's behind the plates then?
Right, some sort
Was
of
it like
cheaper
nickel?
metal.
Is it like nickel or lead or nickel
It's
or zinc or something? Not lead. That would.
one would hope not, but
Yeah, I
I
mean
feel
that would be
like
like counterfeit. Lead would be counterfeit bars, right? That are. I think there was like 60 tons of silver, and they drilled through them in China, and they found that most of the bars were lead. I think.
yeah, unfortunately, that's not terribly surprising. You do see a lot of funny business in the bars, especially ones from overseas. So, I personally think that it's a good idea to have physical and to have some that you're able to, kind of keep as a insurance policy with no counterparty risk. But I also think you have to be very careful about where you buy them, and you have to do something to validate that it is the genuine article. Obviously, that testing is a little bit destructive on bars and coins, but it's worth it to know you have the real thing.
Oh yeah, especially if it's a large order. Yeah, you don't want to be screwed over that much. It's a mess. I just saw an article that like some of the gold storage companies don't want to pay for insurance fees, so they could get screwed over with counterfeit bars, and then they don't have the insurance money. We're starting to see, I guess, the old Warren Buffett saying, right? You start to see who's swimming naked when the tide goes out. So you're starting to see that some of these companies that should be profitable at the current gold and silver prices, they're coming up with excuses that, oh, we don't want to do this, and oh, we don't want to do that. It's red flags there.
Yeah, 100%. And I think that it also just speaks to that in this space in particular, and this is probably one of the reasons that, buying gold miners is pretty unpopular with money managers. There's a lot of dishonest management across this space. So you just have to be super careful with who you do business with, vetting them. If you're buying gold and silver, you've got to do quality assurance and test it. If you're buying a company, you really got to know and trust the management and continue to check in and follow up, especially if it's an earlier stage company that's pre-production.
Okay, a couple more questions before I let you go. So, I want to ask you about just-in-time supply chain and globalization. I think a major theme that we're seeing here with a lot of the policies, and they've been accelerated the last couple of years, especially with Trump winning his second term and coming in, but it was already kind of headed that way, is that a lot of the globalization, the just-in-time supply chain with the tariffs and the other stuff that Trump is implementing with policies with Greenland, going into Venezuela, it's basically admitting that would you agree that the age of globalization, just in time supply chain, relying so much on China for the US, those days are ending, and that because of that we're looking at much more demand for domestic sources of energy and raw materials. And then you add on top of that with the currency debasement from all these governments and then all the new technologies that are lining up, they're going to be very energy intensive. And we're not just talking data centers here. We're talking robots, electric vehicles, drones, all these types of new technologies are going to be very energy intensive and very, very intensive for the amount of raw materials needed for these new technologies too.
I think that we're still going to have something that resembles a global supply chain, but we're going to attempt to become more domestically self sufficient and resilient. And it's going to take a long time, but we're going to do more and more of that. And I think we'll also be working more with countries where we have alliances rather than countries where they might use exports as a negotiating tool or as a bullying tactic. In terms of the demand, I would have to say I agree that the demand is going to have to build for a lot of these raw resources, especially raw materials. I think we're probably a little more well supplied with energy than some of the AI, energy panic suggested. But I do think energy utilization is going to go up, and I think it's going to go up due to a blend of new data centers and industry reshoring. Because once we do get robotics to a point where we can automate factory lines, eventually you're going to see a lot more companies embrace that, and you're going to have less human workers, but you are going to have more robots that need energy to fulfill their purpose, and you're probably going to have a higher speed of manufacturing, which, at least initially may be more energy intensive as well, like going from an 8 to 12 hour shift to a 24-hour rotation of robots. I could imagine that might increase the energy costs, especially as we roll out more and more new factory square footage. So yes, I see a future with more raw material utilization and increased energy utilization. I don't think it's going to be a full-on crisis like it's been described. I know the AI doomers have been kind of describing it as a future with no water, no energy, and you can own nothing and be happy. Kind of maybe when we get to the point where robots can fully replace humans and AI can fully replace humans. But personally, I feel like that's further away than, say, Microsoft's head of AI, who said it's 18 months before AI takes every single white collar job. I don't think so. But I do think that over a longer time horizon, say maybe 5 years, that's not so unrealistic once we start to see the next step beyond large language models and generative AI, where we have real artificial intelligence rather than probability engines.
Well, they are taking jobs. It's just mostly the entry level jobs. So the college graduate from a elite computer software engineering or computer science program, like at Stanford or some of these other schools, they thought they were going to get a six-figure entry level job, and the software jobs are just really not there. So it's really the entry level jobs that were high paying that are evaporating, I would say, because of AI. It's not necessarily all the high paying jobs, all the white collar jobs yet. So like the law firms, they will adapt as the software improves. But overall, like people saying that there's an energy crisis. I mean, that's maybe with nuclear power because nuclear power is so slow to bring online. The U.S. has tons of natural gas, tons.
Yeah,
So
it does.
we have tons and tons of natural gas. It's a question of price, question of infrastructure there, building out the pipeline capacity, building where the Stargate facility is, Stargate for OpenAI or whatever other company comes after them and takes over the facility there. That's not that far from the Permian Basin. So they could build pipelines to the Stargate facility. They can build a separate power station there. It's not like they have to, pipe the gas all the way across the country or put it on an LNG tanker from one part of the United States to all the way across the globe. They don't have to do that.
100%. Things are changing fast. There's going to be a lot of opportunities. I think that for folks that are out there that are nervous about the way the market's been trading, make a shopping list. Look for some of the things you want to own because we may get some better prices. We may break this trading range in the S&P to the downside. You might see better prices in a variety of areas, but for now, I think it pays to be defensive and have a decent allocation to defensive stocks. I think there are ETFs that can accomplish that, like SPHD. And I also think that just looking at some of the beaten down defensive companies, like maybe a General Mills, there might be some opportunities in plays like that just to shield, just to add a larger percentage of portfolio allocation to areas that are marked down, that pay a good dividend. And in fact, one of the things that I shared with Trader Aid members earlier this year was a defensive portfolio. About 15 stocks balanced across industries with a composite dividend yield of about 6%. You basically get paid to sit in a basket of stocks that should preserve your capital better than the broader tech weighted index, where you have about 40% exposure to tech.
Yeah, I'm looking at undervalued companies that still have growth. So I look at free cash flow yield or mispriced assets. That's how I found Cameco 3 or 4 years ago during the pandemic when it was between $8 and $22 a share in a trading range and no one wanted it. I was getting like nasty emails, even saying nice things about Cameco all the time. I think it hit $140. so
Nice.
so so the patrons who read the articles and bought it as a speculation play, it was I thought the best, safest uranium play out there. Over Kazatomprom because I didn't trust their accounting, although Kazatomprom is the low cost producer, but Cameco is what listed on U.S. exchanges and in Canada. I'm looking for, what's the next Cameco? Looking at free cash flow yield. Now, obviously, ExxonMobil stock, that stock is going parabolic, but a lot of the other US and Canadian, the small caps and the mid tier oil and natural gas producers, their free cash flow yields, Mayhem, are between 9% and 15%, pretty much across the board. They've been in a bear market, a trading range for the last two years or so, a little bit longer than that, give or take. Do you think that there's good undervalued growth there with oil and natural gas mix from U.S. and Canadian producers?
Yeah, I think so. I think you're going to want to be in oil services more because they're a little more price agnostic. And we know that the drilling activity isn't going to slow too much unless we get meaningfully below 60 for some period of time. And so far, prices have been resilient. We've seen a bit of a bounce back, some of it from geopolitical tension. But I think we could carve out a low in the low 60s to mid 60s and maybe kind of trade sideways to upwards from there. I've been liking companies like Schlumberger and Halliburton. They've had these great breakouts from a long period of consolidation. The way that I look at that technically is it's like a coiled spring, and that directional release of energy is commensurate with the time it's spent moving sideways. So we've got a lot of room left in these. And I like them because, you're still going to see oil services, especially as they help companies do more drilling activity with less human beings or employees. These companies are going to be in demand. And if oil prices appreciate, that's just another upside catalyst. You also have Schlumberger more than likely getting involved with what's happening in Venezuela, like Exxon. So that's an upside catalyst. So yeah, there are parts of the space that I find very attractive and continue to want to trade and invest in.
Well, I don't think Exxon's going to go into Venezuela right now. Chevron's there. They were there like on some type of smaller deal, but I don't think most of the companies are going to invest in Venezuela right now. It's not really safe, and there's not the infrastructure. But I was actually seeing some. You mentioned Schlumberger. Some of those companies they're actually using what satellites and artificial intelligence software. They're becoming way more efficient at drill targets and finding oil, finding natural gas, finding mine deposits through satellite and AI software. They're actually using the software to huge advantage. They don't need as many humans, and the software is actually helping them find better drill targets now. So there's going to be even more deposits found with the innovations in the software and the other technology with the satellites.
Yeah, I could see that, and also AI playing a role in that. And that's actually something that companies like Palantir do in the energy industry is help to optimize for better drilling, for being able to find higher quality deposits, and essentially being able to get ahead of preventive maintenance that could take equipment offline so that you have more continuous operations. So there's these adjacent plays as well where technology is helping to augment and improve these industries, like you're saying with the satellites and other areas as well.
Given your tech background, one of the tech subsectors is 3D printing. It's been in a bear market for 6 or 7 years. I mean, most of the shares are way below $5. They were talking about forced mergers. There's no capital available. Do you think that 3D printing still has a bright long-term future, and that the sector is going through a painful bear market? They're going to adapt and come out of this, or do you think that that sector is not investable?
I think that it can be two of those things at once. I think that 3D printing has a big bright future ahead, but it's also fully commoditized technology, and there's not a lot of companies that have a durable moat that makes it worth investing in them.
Oh, you didn't make things easier for me. I mean, I know what 3D Systems and Stratasys were going to do a merger a couple years ago. And actually on paper, the combined company looked pretty good. They were going to fire a bunch of the upper management, so they were going to trim a bunch of the fat. They were going to focus on free cash flow, and they were going to have profits in a lot of different industries, like half a dozen. And then the board of directors, because they weren't going to get a lot of extra, stock options and other stuff, they didn't like the valuation. They canceled the merger. So the industry is not, adapting to the market conditions of a bear market right now. Unfortunately, that's what it looks like to me.
Yeah, there's just not the discipline among management in that space. I haven't looked at those companies in a while, but when I did, I just saw really kind of loosey goosey management, lots of aggressive spending, poor discipline on compensation and on other kinds of operational and capital expenditures. So that's going to be an issue. It's also hard to say I want to invest in companies in the US that are doing this when, again, it's becoming a commodity technology, and a lot of the 3D printing stuff is coming out of other countries as well that's very competitive. So for me, it's just, you know, part of my investment framework is looking for companies that can have an advantage over competition and that they can maintain that advantage and build on it. In this space, I see the opposite. I see as the technology improves, it's going to be more and more commoditized and deflationary, and margins are going to be practically non existent. It's going to have a long, bright future in the sense we're going to be using it more and more for all kinds of different processes, like building living structures and building products and all that. I think that's great. But I don't think that there's a company that, unless there's something really disruptive that can happen, that really has an edge.
Very interesting. So yeah, as we wrap up here, I want your so you mentioned software companies. I talked about U.S. and Canadian oil and natural gas producers, the small and medium-sized companies, not ExxonMobil. ExxonMobil shares are up enormously, but pretty much a lot of the other oil and natural gas producers in the U.S. and Canada, the discounts are cheap. They're at very high free cash flow yields. The valuations are very attractive and reasonable. They're not priced for a rebound in oil and natural gas prices or any growth. Are there any other sectors where you think there's good risk and reward, undervalued growth, similar to, say, uranium companies a couple years ago, or gold miners from a few years ago? Are there any similar industries, risk and reward, you think could be similar in the next 12 to 18 months?
I mean, I think software is one that you still have to look at. I think materials has a lot of upside from here for all the reasons we've been talking about. I think you cannot ignore small cap value here either. The S&P 600 value looks really, really attractive on a number of different benchmarks. And then I also think you can't ignore international stocks, especially in emerging markets. 2026 is starting out as another year where US stocks are underperforming international stocks by this time, at this point in the year, by the most since 1995. And last year was another year where there was similar levels of underperformance in the US. So I wouldn't want to be US centric this year. I think you have to make a shopping list of emerging markets to deploy capital into as well, not only as a dollar hedge, but also as a long term investment opportunity. You're seeing a breakout out of a multi-decade period of consolidation and underperformance from emerging markets to the upside, and that's going to have major continuation. You can also see it in the flows. They're really starting to pick up. So for me, I think that you've got to diversify. You've got to have exposure to some of the actual cheap defensive stocks. I think, oil services are a good area. I think materials are a good area. I think that you can start to look at some of the regional banks that got beaten down and didn't recover too much because the widening spread between twos and tens is helping them to improve their lending margins. And I think you have to look at small cap value and overseas to emerging markets.
Well, commodities would give you emerging market and global diversification to a certain extent, because a lot of the best commodities, the new discoveries for oil and natural gas, or a lot of copper mines, they're not in the United States, they're not in developed countries. So when you mention materials, are you specifically talking about copper, or are you talking about other types of materials?
Copper is definitely one that I'm interested in. Nickel is one that I'm interested in. I'm still interested in looking at lithium, although I don't think it's going to have as long of a time horizon that people might think. But Albemarle was one of the ones that we had been getting long last year into what we thought would be a pretty remarkable uptrend. It has performed like that. So still interested, still think there's a little more upside in that. But overall, I think that also owning a materials ETF is not a bad idea. You could look at something like global materials ETF, something like DMAT isn't a bad idea here as well. But basically, I feel as though we're in an opportunity environment where there's a rotation out of high beta tech and growth. It's going into other parts of the market that have better valuations and more realistic near to intermediate term upside catalysts. And we've got to be very strategic. It's much more of a industry, region, and stock pickers market.
Is the large materials ETF with the copper miners and the base metal miners, is that XLM?
Yes, it's XME, I believe. No,
Yeah,
it's not.
I can't remember offhand, because I know XLE is the energy one and XLF is the financial one. I can't remember what's the large cap materials one offhand.
Let's take a look here and see.
It's got like what, BHP Billiton, Rio Tinto, Freeport
It's
McMoran.
XLB. XLB is in Bravo. That's why it's kind of a weird one to remember because it doesn't have a letter associated with it that conjures up materials.
Okay, yeah. So it's got, I think, the largest base metal miners. So the copper miners like Freeport McMoran and the diversified base metal miners like Rio Tinto and BHP Billiton are in there. Those are some of the largest, and a few coal miners. I think it's got most of the mix of the base metal miners. Although might have a merger, so it might be what Glencore and Rio Tinto. I think we're talking about merger. That would be the largest mining merger in history.
I think it's got Lignite, Newmont, Freeport, CRH, Sherwin-Williams, Air Products and Chemicals, Ecolab, Corteva, Nucor, and Martin Marietta Materials as their top 10.
Well, some of those miners might not exist in a couple of years, so we could see a mergers and acquisition boom for some of them, especially if they have a good amount of gold byproduct there and they haven't hedged it. That's a lot of extra free cash flow for gold and silver that they weren't counting on.
Yeah, that's a great point. I do think we'll see more consolidation in the space. It makes sense. There's also a lot of smaller companies sitting on decent deposits they probably won't be able to take full advantage of.
Yeah, and they have to replace the reserves in the mine, and then they're going to probably look to diversify into more pro-mining friendly countries. So, because it looks like Mexico, there's a lot of red flags now with Mexico. There was I don't know if you saw the silver miner. There was Vizsla Silver. There was a hostage situation.
Yeah.
Yeah, so I have friends now that are panicking with that.
Mexico's dangerous. What can I say? I don't want to invest there right now. I mean, there was a minute where the Mexico country ETF was a strong performer, and we were swing trading it out of relative strength, but that was a 2024 story, and a lot of things have changed since then. So I don't really have a lot of interest in being long there right now for risks that you mentioned, but also economic risks as well.
Well, they also delayed the permits for a new open pit mine in Mexico. They're delayed a long period of time, so it's more expensive. It takes more years. So a new mine in Mexico is much more difficult than in the past bringing it online, just from the permit standpoint. But as we wrap up here, I want to thank you so much for your time today. I've kept you for way over an hour. Please tell my listeners more about MacroVisor and TraderAid.
Sure. Yeah. So Macrovisor is all about looking at the big picture, macro, top down, and then finding opportunities where there's momentum and macro coming together. And it's both a service for institutional and retail investors. And TraderAid is all about helping traders build their edge. So if you've been struggling to become consistent, if you're not finding your discipline, or if you want to gain access to cutting edge trading tools, actionable ideas, and institutional grade research for retail prices. That's what we're all about. So you can learn more at Macrovisor at macrovisor.com and about TraderAid at traderaid.com. And you can also check out the website that I'm starting to build out at my own namesake at marketsandmayhem.com.